we definitely see a downturn in the stock market. We see a downturn in the economy, but I also see a downturn in real estate prices. And as they continue to fall, as the economy softens, as the markets weaken, there's going to be all sorts of deals.
We're doing this for the ability to pull the money out and put that money to work while that money's in there compounding for us. It's compounding uninterrupted at that dividend rate, even when that money's out of the policy.
The only vehicle on earth that can do this is a specially designed whole life policy. This has been being done for generations, for decades, for centuries. The question is why are you not doing it? Welcome back, everybody. Another week, another wealth webinar. And today we're going to talk about you being your own bank, but we're going to talk about you being your own bank in two different capacities. Number one, real estate. We're going to dissect real estate, but we're also going to hit on another thing that I thought would be really fun today. And that's talking about owning the policy within your corporation or your entity or your LLC. And proper uses of doing that. Because a lot of people come to Stephen and myself, as well as our team, and they ask us, should I personally own the policy or should my company own the policy? What are the advantages? So we're going to dive deep into that. Some uses on the COLI side, company-owned life insurance versus the personal side, so that you all can dissect which one works best for you. And then I'll share how I'm doing mine, and Stephen can share how he's doing his. There's a lot of different sources of money, and I work with a lot of clients. And what I find is a lot of people have lazy money sitting in old 401ks, old IRAs, and things of that. Now, I know we do a lot of trainings with Greg Herein about self-directed IRAs, but you've all probably seen this, but I want to do this again because I just feel it's so important that you understand the impact of using a self-directed IRA to be your own bank. So what I'm going to do here real quick is I just want to kind of walk you through these little slides here, just as a reminder, if any of you have money in the markets, if any of you have money sitting in an old 401k or an old IRA and it's managed by some advisor, a Charles Schwab, a TD Ameritrade, a Vanguard, maybe whatever, advisory firm you have. One thing we're going to do in a second is I'm going to have Stephen pull up a chart of the Dow Jones, and we could do the S&P, we can do the NASDAQ, you name it, we'll do it. And I want you to see where we're at in the market cycle, because I can sit there and tell you that the markets are going to go down. I can sit there and tell you that, it's going to fall apart, but I think it's real easy for you to see where we're at if I just give you a snapshot of it. The thing I'm trying to preface here, if you're trying to make money and trying to make a bunch more gains in the stock market, I got some bad news. We're probably at the top or very close. We're testing highs right now. We're trying to push through. The markets are trying to push through the highs, but how can the markets push through the old highs when the economy is slowing down? It's not hard to see that the economy is slowing down. Unemployment numbers are going up. You're seeing a ton of companies laying people off. You're seeing weaknesses outside of, Stephen, how many are the top, remember earlier we looked at the top companies, that heat map? Do you want to pop that up on the screen? I really want to show everybody this because this is the illusion that all of you are facing when you look at the broad-based indexes, the broad-based stock market, and you see it going up. It's an illusion right now. And Stephen and I talked about this in WTF, but I want to show it to you again here in just a moment, because you're literally looking at not the overall market. Like when you think of the Dow Jones or you think the S&P 500, you think of 100 or 500 of the top stocks, right? That's not what we're playing with here, because most stocks right now are losing money. Most of them are losing money, but there are a couple that are making money. What companies are those? NVIDIA, Meta, Amazon, Google, Alphabet as you know it. And when we look at this heat map that Stephen's going to pull up here in just a second, it will show you how much of the overall indexes these companies make up. And I think it's really important that you see this. Stephen, what does this represent here? This chart represents what index?
It's the S&P 500 performance this year. And so it just kind of, or maybe this is daily, actually. I mean, this might be daily. Let me pull up the annual. Daily.
Yeah, I want you all to see the yearly. Okay, and we could do any time frame. It's going to vary, but it's almost all the same companies. Many years ago, we were doing trainings talking about the FANG stocks. Okay, Facebook, Apple, and the other FANGs. Here we go. This is the year, right?
Year to date.
Here we go. I want every one of you to just look at the year to date. Okay, there's 500 stocks on here. Okay, there's 500 stocks. And how many of you think that all those stocks make up a really big part of this index? Or how many of you think Apple, Microsoft, Nvidia, Google, Amazon, Tesla, Meta, LLY? What is LLY? That's I should know that. You know, you got Berkshire B shares.
Yeah, it's Lilly and Company. I don't know.
Lilly. Okay, so I'm not all that familiar, but just look at that. Those are the majority of the S&P 500. 1, 2, 3, 4, 5, 6. You could maybe say 7 companies are really dominating this entire index. So what happens, and we'll leave Apple out because we all know Apple's like the champ right now. I mean, they're just ginormous. But what happens when Microsoft and Activision, when their deal falls apart and it doesn't happen? What happens when Microsoft has some bad news come out that they're not winning the AI game? What happens when Amazon or Google, they're not winning the AI game? Like, every one of those is one event away. And then right here, what do you got here, Stephen?
So this just shows like kind of what that heat map is showing. So the top 5 stocks, which are Apple, Microsoft, Alphabet, which is Google, Amazon, and Nvidia, this year are up 56%, with the rest of the S&P, including those, the S&P total is up 8.9. So if we were to take those 5 stocks and just measure it on the S&P 495, so 495 stocks without the top 5, the S&P would only be up 1.5% this year.
You can do better in a savings account. Almost any savings account you put your money in pays you more than 1.5. So this is important for you to see because we've been saying this over and over. And instead of us just telling you now is a good time to sell, you should look at exiting your stocks, buy low, sell high, and don't lose money. Know when to hold them, know when to fold them. But like, I mean, I don't know what more to show you. 5 stocks are dominating the entire S&P 500. And those 5 stocks are making the positive return look what it does. But if you don't own those stocks or have exposure to those stocks, or if anything happens to those stocks, the rest of the market is literally not holding its own. So you really need to ask yourself the question is, do you want to play that game? Do you want to bet everything on those 5 winning horses? Or do you want to get off the racetrack? Do you want to get out of the game, lock in your gains? Because right now, most of you, I mean, as you see from the numbers, you're up. So if somebody just said, hey, I'm going to give you one last chance to walk away from this and make money. But if you don't, there's a very strong probability you're going to walk away with a loss. Would you walk away with the gain? I sure hope so. That shows that. It really does. It paints the picture. So what does it look like? Go ahead, Stephen.
I was going to say, technically, like the diversification model, we were talking about this earlier, as advisors, we're all about diversification, but it's diversified in the stock market. So what that chart's showing is we basically, if you have like a foundation for a home, let's say those 5 stocks are the pillars that are holding up the other 495. But if one of those pillars falls, what's going to happen? Everything's going to come tumbling down. So diversification is technically working in that picture. But are you willing to bet everything on one of those 5 pillars, 2 of those 5 pillars not coming down and everything tumbling around it?
I love what Mike said here in the chat. He said 52-week high today for the Dow Jones. Prepare for the roller coaster ride. You're at a 52-week high. I mean, there should be like warning, but this should be like the stock market, when they ring all the bells and it's a crazy thing. Like this is your bell ringing. Get out. Move to a different asset class, diversify to a different asset class, protect and preserve your money. All of it's right there. And of course, Lilly is a big pharma company. I don't really follow pharmas. So unless you're talking about Johnson & Johnson and the big ones, like I just don't follow them. So, but that does make sense that a pharmaceutical company would be there. And then I love Aiknot. He said, wait, what? Buy low and sell high? I thought it was the other way around, which I know you're all laughing at that, but like what he's saying actually isn't a laughing matter because most people are buying high and then they will indirectly sell low when the market falls apart. So if people are buying the market right now, they're buying high. There's no ifs, ands, or buts about it. You're not buying low. I hope you all realize that. So what's the alternative? I talk to a lot of people. I review a lot of portfolios, and I've been doing this for many, many years. And one of the things I see is that people get stuck with an advisor or a brokerage or in an advised account. They get a statement. It's got 15 pages of just numbers and all, and they don't even, how many of you actually look at your statements? Let's be honest. Do any of you actually look at and understand the statements that you get from your brokerage or your investment accounts? Does anyone get them and actually review them? Or do you just look at the first page and see if you're up or down? Of course, Mark Perry does. Rick does not. Okay, Chris does. Tess does. So you might have a 50-50 thing going on here. Now, let me put it to you this way. Most people, when they look at their statements, they're looking only at what the statement's showing them. They're not actually looking at the entire thing. Like when I look at a statement, I look at it differently than you. A lot of times when I look at it, I'm going to look at what is your cost basis? How much money did you put into this account? And then I'm going to look at your current value. How much do you have in the account? And then I'm going to figure out, is it a gain or loss? And I'm going to figure out what kind of a gain. The one I just looked at was a year-old account, a very diversified portfolio, but it was diversified only within Wall Street stuff. It was heavy in mutual funds, had lots of stocks, it had barely any bonds, which surprised me, 1% in fixed income, and it had a couple of ETFs mixed in there. The best return out of the 4 accounts I reviewed was 7% for the last year. The worst one was a loss. Now, the thing that most people don't look at is they don't look at the return and then look at the management fee it costs to get that kind of a return. When I factored in the management fee, which was 75 basis points, which is not high. Matter of fact, that's a very fair management fee, 75 bips, 0.75%. When I factored that in, this person barely made any money at all. Most of what they made was paid back to the advisor in a management fee. Now, I'm only looking at 1 year. Some of you are like, oh, that's a skewed thing. You should be looking at 5 years. Why would I want to look at the last 5 years, the strongest bull run in history? I want to look at where we're going, not where we've been. The thing I'm suggesting to a lot of you is that you just really take a deep, long, hard look. You know, I talked to Mark a little bit about this the other day on the phone, a deep, hard look at your current portfolios and make a very conscious decision, not based on what I say, not based on what Steven says, but based on pure fact and fundamentals. Should I take my gains off the table right now? What do you have to lose? If it's an IRA and you sell your stock, you sell your mutual fund, you sell your ETF, is there a tax hit? No, but you keep the gains. In a non-qualified account, if you sell the stock, sell the mutual fund, and you have a gain, yes, you're going to have a gain that's going to be taxable. But how many of you want to pay taxes at today's tax rate or taxes at where taxes are going to be next year, the year after, the year after that? I hope all of you think you want to pay taxes today because we're at the lowest tax bracket we've been at ever, really, and taxes are going to go up. But not only that, would you rather pay taxes this year on gains, or would you rather be able to write off the losses next year? These are valid questions that you need to ask yourself, because you can pay tax on the gain, or you can just wait till next year, the year after, and then you can just use the write-off, because that's what it's going to be. You're going to have a loss, and hey, great, you get to write it off. Maybe you need the tax write-off. That isn't the way I would take the tax write-off. I'd go buy a 6,000-pound vehicle and do the 179 deduction, or I would do the Augusta rule. I'd find a good accountant that could advise me on how to get better tax write-offs than intentionally losing money because you're just not paying attention.
This was a Bloomberg article from this morning, and it just says big tech is eating the stock market. And basically it says just 7 companies now make up 26% of the S&P 500 index's total value, up from 20% at the start of the year. The companies Apple, Microsoft, Amazon, Nvidia, Tesla, Alphabet, and Meta are all valued at more than $11 trillion. Without their gains, broader market growth would have been far more muted. What's more, these stocks now traded at a massive premium to the rest of the market, an average of 38 times their blended forward earnings compared with 20 times for the S&P as a whole. That's largely driven by expectations for artificial intelligence and how the technology might generate new business. In essence, there are 2 issues. Because expectations for these companies are so high, it will be very easy for them to disappoint investors. And if they do disappoint investors, their size means they could drag down the rest of the market. A wobble from just a few of them would have pretty significant implications. It risks hitting both the value of your 401k and companies' ability to raise capital and fund their growth plans. So it's like a domino effect. Companies will report earnings from the March to June quarter over the next few weeks. The process kicks into high gear next week with some big companies reporting. So we could start seeing stuff happening right now, very, very soon. So the spring quarter usually isn't a big deal. The last 3 months typically are, but suddenly, however, the market is paying closer attention after what happened last quarter. In May, the chip maker Nvidia shot up 53% higher than they expected, turning it into the first $1 trillion chip maker, but it also raises expectations for companies to outperform. In order order to justify generous valuations, companies will likely have to beat analyst expectations and offer similarly bullish outlook for the coming quarters. So some of these companies have seen a 50 to 60% increase in the share price over the last few months. There is a point where they need to deliver. So there's a lot of worry that they're not going to be able to deliver on these huge gains and these expectations that they currently have. So the real concern will be if a few companies genuinely disappoint. If Meta Platform says the advertising market is weaker than expected, for instance, or Microsoft telegraphs that companies aren't adopting its AI offerings as quickly as investors would like, that's when things might get really messy. So that's the article. And then, just looking at the broad, like Meta launched Threads, which was supposed to be a Twitter competitor. It's supposed to take over Twitter. It's this new Meta Threads, which is Instagram. And so they had a huge surge of users join Threads and use it the first couple of weeks it was in existence. And since then, over the last week, their daily users have fell in half. So they're already starting to come out with, is Threads going to fail? Is it ever going to make it? What's that going to look like? And Meta was really banking a lot of their expectations on Threads taking off this year. So we're starting to see little things like this happen that are going to cause massive changes in the market very, very quickly coming up.
I think there's a lot of really good stuff you can take out of what Stephen just gave you. And, I'm coming over here and just looking at the comments, Todd said, sounds like an echo of the dot-com crash. Any of you that lived through the early 2000s, folks, does that not sound identical to the early 2000s? Yeah, the tech was a little different. It was still in, a little bit more of an infancy stage than it is today, but literally all of this growth that you're seeing in those stocks that we're talking about is all AI based. It's the buzz, man. It's the thing. But is it going to be enough to keep all those companies up here? This is pure speculation. This is pure market speculation at its finest hour. Identical to the same market speculation you had back in the days of the dot-com or before the dot-com crash. Everything was based on number of clicks, not actual dollars in the bank, number of clicks. Think about that. You really, really got to look at this. I'm not trying to paint this scary picture of what's coming, but how can you ignore these things? Everything that you're seeing, it's not an illusion, but it's all speculation. It's all based on a few little things that is driving this market excitement, and that's it. If it doesn't work, it's gone. It's gone. It's gone. And the Fed, let's not forget the Fed. They're like the sniper out there. The Fed's ready to pick off anything that's going to challenge their pursuit in bringing the inflation target down around 2.5%. AI hype right here. Talk about that, Stephen.
Yeah, just AI hype could end up like the dot-com bubble veteran investors warn. I'd put much larger odds on it coming down. So people like OpenAI CEO Sam Altman has cautioned against the recent hype. Veteran smells very much like the dot-com era. Investors are loving it right now with chipmaker NVIDIA sitting at $1 trillion market cap, but they're saying, the AI boom could end up the same way as a dot-com bubble. A veteran investor tells companies that even mention the word AI in their earnings are seeing boosts to their share price. And that smells very much like the dot-com era. So we're starting to see a lot of articles like this come out as well.
So with all that being said, a lot of people are just okay, so what do I do? Well, that's easy. I mean, Robert said alternatives. Absolutely. Look at alternatives. Anything non-correlated to the overall market is a great way to look. And we help people do this all the time. We're going to get into the specially designed whole lives and BYOB, but you see, BYOB, be your own bank, is not just whole life. Be your own bank can be exactly what Chuck and Mary Jones did. This is old. Okay. This is very old, but they knew nothing about the stock market. Okay, they were way behind in the retirement planning. I mean, look at it. They were 10 years from retirement and they had $350,000 in both of their retirement accounts. I think all of you know, if you had 350 grand, 10 years from retirement, you're in a little bit of trouble unless you're okay living off of Social Security and a meager income. But that isn't their plan. They didn't want to do that. They wanted to do their stuff that they love to do, ride their horses and do all the things they want. Like all of us, when we retire, we don't want to do less. We want to live our life, because we have the freedom of time back when we don't have to work. Well, that's what they wanted. They didn't want to manage investments. They didn't want to sit there and decide what to buy, what to sell, when to buy it, when to sell it. They just wanted nothing to do with their investments. They wanted a check every month. So what they did is they became the bank. And you probably have seen this. This is a really old one, but no matter how old it is, it makes a ton of sense. So what we got to do now is we're going to fast forward here, okay, to 10 years after. They were contributing the max to each of their IRAs, okay? It grew So they became the bank, they lent the money out. Now, back then, private money club did not exist. So they would have to find people to lend to. And luckily, they knew somebody named Greg Herein who kind of helped them a little bit. But they lent their money out at 9%. Now, I know that's a far cry from what you can get today. But 9% is better than 1.5% if you remove those, those couple stocks out of that entire mix. 9% is better really than what the market always produces. And 9% is fixed. It's not 9% one month, 4% the next month, 10% the next month. It doesn't fluctuate. It's 9% flat, secured in a first lien position. At 9%, their balance of $1,026,000 produced an income of $92,000, $76.95 every single month. All they did, folks, is changed one thing, and that was where their retirement savings went. They didn't keep it with the advisors and all the fancy portfolios and all the stuff that we just talked about. They shifted it to a self-directed IRA where, just like, one of our, I think it was Robert who said that, they went into alternatives. Their alternative they chose was lending on real estate, a tangible asset, a secured asset. And they continue to do this. They never touched their principal. So they got a check coming in every month of $76.95. They still have $1,026,000. This is a long time ago. I bet you it's still continuing. Stephen, can you just elaborate on this a little bit?
When it comes to controlling your money, I mean, we're showing that example there where they used the Roth IRA or they used their self-directed IRA to create that income like that. And so, like Chris said, it's not just all about the whole life policy and using that with the infinite banking concept, but it's really controlling all of your wealth and controlling all of your money and being very, very smart with it and understanding that it's not about making money, it's about how much money you can keep. So we teach this in multiple different strategies in multiple different ways. And so what we really want everybody to do, and we're going to get into these alternatives to the stock market here in just a second and what that looks like, especially related about real estate. But before we get there, start thinking to yourselves, like, where is your money? What does that look like? And, what is it that I've been told my whole life that I can start pivoting away from and getting more into what the wealthy do, mimicking what the banks do? That's what being your own bank is all about. So if we take kind of a step back, I just want you to think to yourselves, okay, so right now, all the money that you make, where is that money going? Is it going to bills first? Are you putting anything into savings account at the bank? Are you investing just straight cash? Like, what are you doing with that money? And then let's take a look at that income that you have, that money that you have coming in, and what can we do with that money to be a little bit smarter? So for instance, that just cash flow that you have coming in, one thing that we do is, instead of paying all the bills first and then putting a little bit into the savings account at the bank at the end of the day, we consider ourselves important. So we're going to take money. This is what Chris and I do, is we take money as soon as we get it and we put it right into our own banking system, which is the specially designed whole life policy. Now, I do that first before I pay any other expenses or anything like that, because I'm important. I want to pay myself first, and then I want to take care of everybody else, which is the opposite of what most people do. And I put it also into a specially designed whole life policy instead of somebody else's bank, because every dollar I put in that specially designed whole life policy is going to compound uninterrupted, tax-free, guaranteed for the rest of my life. And then whenever I need that money, I then have the ability to pull it out and use it for whatever I'm using it for. Whether it's a purchase, whether it's an investment, whether it's paying off my credit card, whatever the case might be. But here's the beautiful thing, is the reason I put it in the whole life is not only does it have that compounding growth, but even when I pull the money out to use it, it comes out in the form of that loan, which allows all that money to stay in there compounding for me at all times. So when we do the comparisons, if I was saving, let's just use a whole round number. If I was saving $10,000 a year and I'm doing it, just putting it into the Wells Fargo savings account and I'm using it as needed, and then I take a second person that's putting that money into a specially designed policy, the same $10,000 a year, and using it the exact same way, at the end of 5 years, at the end of 10 years, at the end of 20 years, at the end of 30 years, the person using that whole life banking system is going to be so far ahead financially than the person that was just doing things, putting money in a savings account. It's unbelievable the difference. And that person did nothing different. They didn't work any harder in life. They didn't work any smarter, really. They didn't do anything different. They just changed where their money went first, into their own specially designed policy instead of to everybody else and into somebody else's bank. So that's one thing we can look at, is what are we doing with just our income, our cash flow? And then if we look at like Mary Jones, the bank of C&M Jones, Charles and Mary, they also took it a step further and said, okay, well, let's not only evaluate our cash flow, but let's look at our qualified funds. Let's look at our retirement money. How can we be smarter with that? And that's where we can really help as well, because there's multiple parts when it comes to your financial life. So that qualified funds, what do most people do? Well, they're throwing money into a 401k. They're maxing out their 401ks. Why? Because that's what they've been told to do their whole lives. They think, oh, that, it's going to be diversified. It's going to go up and down, but at the end of the day, it's always going to go up. Well, guess what? That just doesn't work, especially if you're approaching retirement in the next 3 to 5 years. Good luck. You're going to see a loss and you don't have time for that money to come back up. So let's take those qualified funds and let's control that money. Now, once we control that money through self-directing, and there's no fees for doing this as far as like penalties or taxes just to move it from one qualified custodian to another, but now we have control of that money. So now we can go out there and be smart with it. We don't have to ride that stock market wave. But here's the challenge, is once you control your wealth, whether it's in a banking policy and you're investing, whether it's in a self-directed IRA and you're investing, what do you invest in? Like, where do you put the money? And I think somebody's asking that earlier, like, what's the alternatives? So that's what we wanted to talk a little bit about today is, okay, so what are these alternatives? Should I go out there and should I buy rental properties? Should I long-term rent them, short-term rent them? Should I do flips? Do I have time to do flips? Personally, I sure as hell don't. I don't want anything to do with flips, but I want my money moving in real estate. So if that's the case, I don't want to necessarily buy real estate right now. Well, how can I be involved in real estate without actively doing it? Well, that's where private money lending comes into play. So we can lend our money. And then when it comes to private money lending, I mean, there's 5, 6 different options for that. So which one's best for me? Should I do direct lending to Chris for a flip, just like a bank does with a mortgage and promissory note? Should I join this syndication that my buddy's been trying to hype me up about and get me into all the time? Should I look at a private fund? Should I put it into a REIT, a publicly traded real estate investment trust? Like, how do I invest in real estate passively without actually, the right way and protecting my money in this market? So there is a lot of stuff to it. And that's where basically Private Money Club comes into play that Chris is showing on the screen right now, because not only does it provide you a platform to find these types of deals, no matter what side of the coin you're on. If you're actively, it finds the money. If you're passively, it finds the deals, but it's also educates you. Like, for instance, all of our premier members on Private Money Club are joining us tomorrow evening for a 2-hour coaching call exclusive for premier members. And all we do on those coaching calls is help the students accomplish whatever they want to accomplish with whatever type of real estate they're doing, and teach you these different strategies. And we have coaching programs. So you do need to spend a little time learning this stuff, but guess what? Nothing's easy in life. So if you're somebody that's like, I just want everything given to me, I want a financial advisor to handle it for me, good luck. The Social Security Administration tells us that doesn't work. You take 100 people at retirement age and only 10 out of 100 people are retiring financially secure. I'm not even saying financially successful, just financially secure, meaning 90 out of 100 people in this country at retirement age aren't able to retire with a lifestyle that they want. They go back to work. They have to push back retirement. They have to change what retirement looks like for them. 9 out of 10. That's a problem. So if you're okay with that, then fine, don't listen to us. But if you're one of those, like I like to think, 5 to 10% of people that understand, if I'm willing to put a little effort into something, it's going to make huge dividends for me and my family down the road. Perfect. I've always said real estate is not a get rich quick, but real estate is get rich. And that's exactly what we show with these different various strategies that we teach you.
So every day I go on Private Money Club and I just look. I mean, every day there's more activity. I mean, you can see these are all relatively new, but like this one popped up today. So I want to be clear about this. This was just put up 4 hours ago. I know Nick, we've looked at his other deals, but the thing that catches my attention is a lending opportunity in Florida at 15%. Like, Okay, so then I come in and I start looking at it, and I'm asking always the same questions, because a lot of people, when you're looking at alternatives or you're looking at like, how do I do this? Like, I'm so used to just giving my money to an advisor, giving my money to a brokerage account and putting it in mutual funds or putting money in my 401k. I don't have to think about it. So like, how do I do this? Well, it's not difficult. Emily, who works here, she just started a couple of weeks ago. This morning I was telling her how to underwrite a deal. Literally, I said, here's the deal. So the things I would do looking at this, first off, I know he needs 50 grand. The thing I was interested in is it's 15%. And I was telling her the first thing I want to know if it just says 15% is, am I getting paid monthly? Because I like monthly checks. I like walking to the mailbox and getting a check. And I'm sure most of you do. So right there, monthly interest payments. It's a 12-month term, because I always said, always ask the term. Recorded mortgage. So the first thing I told her, I said, I want to know, am I in first position or am I in second position? Promissory note is just saying that he knows what he's doing. And then when I go down here and I look at the deal, okay, here's the deal. If I open it up, purchase price 275. So I'm thinking to myself when I read that, I'm lending 50, but he bought it for 275. So something's off here. Is he paying out of pocket, or is there another lender in place, that I got to come in after? 40,000 in rehab, ARV 385. I mean, it looks like a cute little house. Looks like a Florida house. I come down here and I look, and this is crazy because like there was 9 responses, and it's like every one of these people was asking the exact same questions. I literally got super excited here because I know a lot of these people. These are private money club members. Good afternoon. What is the lien position? Remember a second ago, I'm like, oh, what position is it? Boom. Rick and Don already answered that. Second lien. So I know I'm in second position. So the next question I'm thinking about is, how much is the first lien position? Like, how much is that first lender lending? Because I don't want to give Nick 100%. I want Nick to have some skin in the game. So then I keep going and I'm just looking here, second position, went through market correction. The project ended up being a net loss for us, but the PMC member was always paid on time. That's awesome. Like, hey, Nick lost money on that deal, but the PMC lender made money. Okay. What is the amount of the first lien? Jack coming in with the question I was thinking. I'm like, holy crap, Jack, how did you know that? And he said, I'd be looking for 280 to 320 of first lien. So what he's basically saying is, Nick's saying he's trying to get 50, but he's probably going to have a hard money lender in place. But if somebody wanted first position, they could. They just need to come in between 280 and 320. And I'd never lend 320 on a deal. It's just not it'd be too thin. At 385, lending 320, I'd put me at too much risk. So, but would I come in at 280? Probably. Then down here, can you send me more information? And then down here, I may be interested in future deals. So you're not seeing this now, but I have Emily right now responding back. But I mean, there's not much more you'd need to know. All I said to Emily is, I said, the thing I would probably ask for in this deal, if I put 50 grand up at 12% for 12 months, are you willing, Nick, to put up a personal guarantee? And if you are, can I see your personal financial statement so I know what are you guaranteeing my 50% with on your personal financial statement? So it's not difficult, folks. It's actually way easier than reading a prospectus. Why is it easier? Well, because you guys already do this. You've all probably borrowed money from a bank. And if you think long and hard, you can remember when you borrowed money from a bank, what the bank was asking you about. So these aren't difficult. And this one here, John, so this one caught my attention because I'm always looking at mobile homes. 4 mobile home investment opportunities. Now, the cool thing about John is I have lent to John. He's never missed a payment. He's never been late on a payment. If I had a question, I could always just call him. He's very transparent. He's a good real estate investor, owns lots of real estate. And I look here, he's offering 14% on 70 grand, 6 to 12 months to buy, fix, rehab, and hold property. First lien position listed on the insurance, personal guarantee. Spelled guarantee wrong, but right there, you can tell John knows what he's doing. He's done this a couple of times because he already knows what we're going to ask him. All right, it's going to be first position. Yes, I'll put you on the insurance. Yes, I'll guarantee it personally. 25,000 purchase, 45 rehab in Friendship, New York. So I know this mobile home park. So I actually already sent a message to John saying, hey, let's talk about this mobile home park investment. But I shouldn't be the only one getting the goods here, right? So these 14%, I mean, how many of you want to make 14% in your money? We showed you the Bank of C&M Jones at 9%. I just showed you a 15% deal, a 14% deal, and there's so many more of these. So it's just when people come to us and they don't know how to do this, I'm just like, you don't really need to know how to do this. It's right there in front of you. And then we have the coaching programs called the Accelerator Coaching. And we have in Raleigh coming up August 4th and 5th, we have an event that we're going over all this stuff in person, live and in charge. We're going to literally be walking you through how to do this stuff. So this stuff isn't difficult. It's not difficult at all. You just need to basically apply yourself. And the other things that we're working on right now, and this is not here yet, we still have a lot of people that say, oh, I would love to do this, but I don't want to manage it after. This is why people hire property management. So think of what property management is to a real estate rental portfolio, right? It basically allows somebody else to handle all of your properties and you pay them. So I started thinking about this, and me and Tess started thinking about this, and we're like, well, wait a second. Property management's good. A lot of people like that because they're too busy to manage the portfolio of assets that they bought. But here we're doing the same thing, but except for our portfolio could be a portfolio of notes, could be a portfolio of lending promissory notes and mortgages, whatever alternatives we'll call it. Why don't we provide kind of like a property management to our clients, but it's not property management. It's almost more like a bookkeeping, overseeing solution. So people can go on, look at the menu, which is Private Money Club, pick the deals, structure the deals, and then somebody else manages it, handles the bookkeeping, puts it all into a structure. Like, we're going to have that soon. And then you just pay a monthly retainer for that service. Listen, I know you're all busy because I'm busy. You know where that whole idea with me and Tess came up? Me, because I've got that problem. I can't manage all the stuff myself. Like, it's getting to be too much. I have so many deals out there that literally me, Emily, and Shauna have been like unraveling my mess of loans. Like, I've done a lot of loans. I think we added up all the loans that I've been part of since I started. And this is not all my own money. So folks, I don't want you to think I'm rolling this deep, but it was over $10 million. That was just deals I've been part of. Okay. Whether I lent 25 or 50 or 100, like $10 million in deals that I've been part of. And as we went through that, we created a spreadsheet of all those deals. And now moving forward, we're now organizing all my deals that are out there now, and we'll be managing all my future deals. This is stuff that we're going to be bringing to the table for all of you because we know you're busy. We know, like, when you jump into something new like alternatives, number one, there's a little learning curve because you're just used to handing your money to the advisor and letting them go and do what they want. But I'm telling you, that's not the right way to do this right now. Maybe for a little bit if you want, but you need to be in control of your money. So we're just putting the structures together. So Stephen, I thought maybe what we could do now is transition a little bit into the golden goose, as I want to call it, and that one change. So a lot of people have money and they're like, okay, well, I can lend from my bank account. I can lend from my self-directed IRA, but all of you know, you can also lend from a specially designed and engineered whole life using a concept called the infinite banking concept. Now, real quick, all of you on here, because I know we have a bunch of new people, how many of you right now have already set up your IBC policies? In the comments, just put IBC if you've already set up your IBC. Look at that. So who said that they just got theirs funded? So they're salivating looking at these deals if they just funded that. Yeah, Will just got his funded. So any of you that are kind of here new, so Stephen's got 4 of them, you know, like that's, look at, they're still coming in. These are all folks that have already set up their IBC policies. So if your advisor, your broke ass brother-in-law, or somebody that you surround yourself with, if you tell them all about this thing that you saw in this webinar and they say, oh, that's a scam. Well, why don't you just ask all those people that have already been doing this? And some of them have been doing it with multiple policies. Ask them if it's a scam. Ask them if it works. Because I'll tell you something, we have over 8,000 clients in this country alone, plus our clients in Canada, and nobody's mad at us. We talked about this last night. It's kind of weird sometimes. As an advisor, Stephen, there was always somebody mad at us. You know, when we were financial advisors, it just seemed like if the wind blew the wrong way, somebody got mad at us. And now with what we do with BYOB and these boring, specially designed whole lives, nobody's ever mad because we show them what it's going to do and it does exactly what we show them. Stephen, you got a couple things that I know you prepared before we got started here. Do you want to dive into kind of what some of this stuff looks like?
Yeah, I mean, at the end of the day, regardless of the type of, investing you're doing, we can kind of do like a couple little comparisons of what that looks like, whether we're using a policy or not, very similar to like the Charles and Mary Jones, how, they were able to do the lending at 9% using the IRA, I believe it was a Roth IRA, and, grow their money tax-free and what that looks like. So we can definitely show this. And then what you decide to invest in, that is ultimately, going to be up to you to kind of learn what you're comfortable with. So are you comfortable underwriting deals and underwriting the borrower and, doing direct money lending? It's not hard once you learn how to do it, but maybe you need to go through our accelerator coaching to feel comfortable doing that. Or are you comfortable, with getting into a partnership like a syndication, but with that, like, make sure you understand it. Or maybe you're in note investing. We could talk a little bit about that, Chris, but or a private fund. A private fund is just where you find the operators of the fund. So for example, Chris and I have a private fund right now called Inicio, and it's been open for almost 6 months. It's closing at the end of July here in just a couple weeks. And we've raised almost $5 million in it. So what we do with that fund is we take that, and there's a few other partners, Kent Clothier, who's done billions of dollars in real estate, Greg Hurling, who's done billions of dollars in real estate, a few other partners in it. So real high hitters that have been doing this for about 15, 20 years that have been through markets. So this fund was created, raised about $5 million in it. And we're going to take that $5 million over the next 4 to 5 years, and we're going to invest for you. So in a case like that, you don't do the underwriting. You just say, listen, I understand that Chris, Stephen, Greg, Kent, and these guys have an incredible track record. They know what they're doing. We understand their business model and the type of deals they're going after, and we want to put our money with them. So you could give us 25 grand, 100 grand, $500,000, and we'll take that in that Inicio fund and we'll invest it for you. So I can show you an example of some of those deals that we invest in where we're getting 22, 25, 30+% returns on the money. And then we share that equity, we share that profit with the investors. In that case, you don't have to do any of the work. You just give us the money and we go and we take advantage of this incredible real estate market that we're going to be having coming up over the next 4 to 5 years and make everybody a bunch of money. So there's lots of different ways to do this. But again, at the end of the day, you can either continue to do it from a checking account or a business account at somebody else's bank, or we can do it from our own banking system. So let me just show you kind of what that difference looks like one time. We can show a couple different examples. All right.
Hey,
so this is just,
I just want to say one thing, about Inicio that I think is very unique. I mean, I've done a lot of funds, and what Inicio was really designed for is everything you heard us talking about, the first half hour of this show was what we think is coming to the markets. We definitely see a downturn in the stock market. We see a downturn in the economy, but I also see a downturn in real estate prices. Okay, and it's already happening. On WTF, I read a report by one of the largest reporting agencies on real estate, and it's absolutely already happening. Real estate values are falling right now, and as they continue to fall, as the economy softens, as the markets weaken, there's going to be all sorts of deals. So Inicio was put together really as I would call it, an opportunity fund, because I've never been able to do this. None of us have. We all missed it. We missed 2008 because we weren't ready. We didn't see it coming, or we were just FOMO'd out. We were just buying into everything. Kent missed it. Greg, he kind of got it, but didn't get it. So he suffered a little bit. Greg knocked it out of the park during 2008, but not the way he wanted to. So when we created Inicio, we wanted to create a fund that would be there to take advantage of these stupid good deals as things deteriorated. In order to build a fund like that, it requires some careful thought. Number one, you need the right underwriters that can find these deals and the right people with the right relationships. Stephen mentioned Kent Clothier. He's iconic in the real estate industry. Like, between him, his brothers, and his family, I don't even know how many hundreds of millions they have in real estate. They're players, and they know all the players. So Kent has a first-hand finger, or however you say it, a front row seat to the best deals. He's going to get them before most people are. Then you got Steve Burns. Steve Burns been in the business forever. He knows all the big guys, so he also finds the deals. So all the people in that fund are literally the right people to find these golden goose deals that pay massive returns or have massive upside. But in order to do that, you have to be able to be patient. And this is the hardest darn thing with every fund. Being patient it's almost not even in the same dictionary as private fund patience. You can't, because most private funds, like the one bank of C&M Jones we're investing in that paid 9%. If you're paying investors 9%, you got to keep that money in motion. That money's always got to be out working. But you see, Inicio, and this is the good and the bad, so hear me out. Inicio pays a preferred return of 4%. And some of you are like, oh, that sucks. So you just showed me a 15% deal. You showed me a 14% deal. Why would I put my money in Inicio at 4%? Well, here's why. Because like I said, you're buying into our talent pool. we're finding the best deals. You're getting paid 4%, but you're also sharing the lion's share of the profit on the back end. Stephen, what is the investor's share of the profit?
So it's 70 to 80%, depending on the level you're in. So 25 to 150,000, you would share in 70% of our profits. 150,000 or more into an ICO, and you would share in 80%.
So in creating an ICO, we wanted that opportunity to be able to be, patient and wait and not have to always constantly take the first deal just so that our money was working for us. So at 4%, we built in an automatic coast. We literally just put the car in neutral and the sucker's just rolling. And then when the real juicy deal comes up, like what Stephen will show you, we can pounce on it, but we didn't have to rush into it. And the only downside is an ICO would not be for people that need income right now, because there's much better ways to get higher income now. It's for the people that want that big return on the back end, but they still want to get paid every month. So their money's actually giving them something that they can live on. That's what an ICO is. It's like no other fund I've ever been part of. And like he said, it ends this month. So if you guys aren't in it, this would be another alternative that you could get into that would really give you the ability to capture just what I think is going to be one of the greatest opportunities of our lifetime. Sorry, Stephen, go ahead.
No, it's good. I mean, and we're very selective on the deals in an ICO. They've got to be the right deal. They have to be high returns. I mean, we just turned down a couple because they were, 15% returns. So if you do 15% at 0.8, it's only a 12% return back to you, which is not our goal. Our goal is to get these things 25, 30+% so we can return the investors at least high teens, if not into the 20s. And that's what we've been focusing on. I see we've just reviewed a couple of new deals that came in over the last week or so that are looking promising, Chris. I know the storage unit one.
I shut down that storage facility one, which would be a good deal, but I just didn't, it was just too risky for me. Like I feel like the bad guy in the fund. I'm so risk averse. I've said no to so many deals, and sometimes I'm kind of like, I'm like down here under the thing. I'm like, no. And I got some pull in that fund. So if I say no, it means we can't move forward with it. But luckily, when I said no, like a couple of the times, they're like, yeah, you know what? I think you're right. And I'm like, because I always felt like I was the bad guy.
Yeah, exactly. But it's good. I mean, that's what it's all about, is making sure we're protecting everything and everything's looking good. So, so an ICO is really fun. I mean, give me a shout if anybody wants to learn more about it. I can send you over the full details, and happy to hop on the phone and answer any questions. But Snaky at privatemoneyclub.com. Regardless of how you're investing, whether it's a private fund and trusting other people, whether you're investing yourself, whether you're actively going out there and buying real estate, let's just do a private money lending example at 12%, just to kind of show you the power of understanding infinite banking in the long term.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. privatemoneyclub.com. Back to you, Chris.
Okay, and then we'll show you a couple different examples. So we all understand, like self-directed IRAs, you're saving money on taxes. With a Roth, you never pay taxes. With a traditional, you're deferring paying taxes and getting a tax break today. So that's one strategy. But here's why we use infinite banking for non-qualified funds, for all the cash and income that we have in our lives. So this would be, this is a policy I did for somebody last year. This was a female. She's 41 years old. She's a real estate investor out in Oregon State. And she had $150,000 sitting around in a bank account and realized that was not smart. But she also realized she was only able to save about $50,000 a year, what she was comfortable doing. And she also knew that just in case something happened down the road, she also knew if she couldn't put the whole 50,000 in there, she could drop it all the way down to just below $20,000, and this whole policy would be fine. So she was like, I'll do it at 50 because I'm like 99% sure I can do 50 every year, but it's nice to have that fallback where I can lower it down the road if I need to. So she was very comfortable with this policy, and that's why we designed it this way for her. This is what she wanted to do, was get more money in the first year and then do this annually moving forward. So a couple things on this. So over here, this is where I was just talking about the contract premium. So you'll hear us say different words when it comes to the premium of these policies. You'll hear us refer to them as the deposits. Again, this is our new banking system, be your own bank. we want to consider the money we're putting into this as a deposit, just like you would if you were to deposit money at somebody else's bank. This is not a premium like a health insurance premium or a life or a car insurance premium. This is now your banking system. So let's start thinking this as deposits. And on top of that, you'll hear us sometimes, how much do you want to fund a policy with? Or what's the funding look like? Are you ready to fund your policy? Exact same thing. It's just the premiums that go into the policy. Now, this overall premium is made up of several different types of premiums. And that's what we do on the back end of this. When we design these, remember, we specially design them for this purpose. And the way we do that is through essentially what's called base premiums, paid up additions premiums, and sometimes we sprinkle a little bit of term insurance in there to avoid what's called the MEC, which are IRS rules and regulations that regulate these things to make it 100% legal. Remember, everything we do has been done for over 200 years and is 100% legal. And people do it, especially the politicians and wealthy do it every single day. So just a little bit about the premium right there. Over here, this is where it starts to get important. So we have what's called the cash value, and then we have the increase in cash value. And before I get there, I will mention the death benefit. So while we don't do these policies for the death benefit, you know, God forbid, I know this person that I did this policy for, she does a lot of outdoors activities and she has a family, and, you know, God forbid something happens to her on one of these camping trips or something. Well, she knows that she has a nice death benefit that's going to be left tax-free to her loved ones, you know, if something did happen. But the good news is she's not getting it for this, she's getting it for this. So it's just like an added benefit over here, which is really, really, really cool. All right, so just a couple things about that. So I will mention, you'll see the cash value over here as well. Let me just clarify that. So this is what's called the guaranteed cash value. So like we said, these policies are 100% guaranteed to grow and not lose money. So they are. So this is what the guaranteed growth would look like. However, this is this company right here is Lafayette Life Insurance Company, and they have successfully paid out strong annual dividends for, I believe it's over 120 years now. And so when we look at projecting this out, and we also know that Lafayette Life Insurance Company is having a record-breaking profit right now. They're paying out record dividends to their policy holders, and that's how these policies ultimately grow. So when we look at this, I'm going to bank on this column over here, even though it's not guaranteed. This is guaranteed because I'm going to go with history, and history and and what that looks like tells me that I should be safe over here. So just so you guys understand a little of the inner workings on what we do with this stuff. All right. So basically, increase in net cash value is showing us each year that I put money into this policy, how much does my bank grow and how much cumulatively is in there. All right. So this tells me in my first year, when I put $150,000 into this policy, I'm going to have $132,538 to pull back out to use. But here's the kicker with this. Remember, I put the 150 in there and I pull the 132 out. Let's say that I use that 132 and I throw that into an active real estate flip. Okay. But here's the thing is, even when I use that $132,000, the full $150,000 is still in there growing through the annual dividends. And that's the beauty of this. Even when you take 132 of the 150 out, all of the 150 is still in there compounding and growing for you. So the second year I put $50,000 into my deposit into my new bank, I have almost $48,000 available to pull right back out to use. The third year I put $50,000 in. Now, look what happens. I have $50,614 available. So what just happened right there? I went and I deposited money into my banking system, and now I'm able to pull more money out to use than I put into it in the third year of this thing. So this is what we call a high cash policy for a real estate investor. The fourth year, we put $50,000 in. Now we have $53,000 that we can pull back out. And I'll show you a couple other illustrations in a minute that actually do the math for you to show you these percentages. But I just want to explain kind of the inner workings of this real fast. All right. Now, so let's say that she's been doing this for a few years and she's actively using all of this cash value over here to build wealth, to invest, to put money into her business, to buy more real estate. And then she gets down to, let's say, the 8th year. And she wants to become a little bit less active and a little bit more passive with her money, okay? So let me show you how this will work. All right, so in the 8th year of this policy, the policy grows by $66,722. To get that growth, we had to put in $48,593. Okay, so if I do the math on that, that's $18,000 of tax-free growth within my banking system, or it can be looked at as a 37% cash on cash gain tax-free that year within my policy. But remember, we're not doing it for this. We're doing this for the ability to pull the money out and put that money to work while that money's in there compounding for us. So what we do in this case is she's going to do a private money loan at 12%. Like Chris just showed you, those 12% are available all day long through Private Money Club. So if we do the math on this, we make 12% this year. She's 48 years old, 12% on the private money loan with the money. Her bank grew by 37%. Now, when you take a loan from your policy to use the money, the insurance company does charge you interest. Now, the interest that they charge you, it's about 5%, but that interest that they charge you is simple interest. Meaning, if I do a private money loan and each month I'm getting interest payments and I'm taking those interest payments and I'm putting those back into the policy, well, at the end of the day, I'm not going to pay 5% on that money for the year. I'm probably going to actively pay about 3% when it's all said and done to use the money that year, because I'm putting the money back into the policy. So it might not be a whole 5%. But for this example, I just wanted to show you kind of the basic numbers here. So if we do the math here, 12% on the loan, 30% growth within my banking policy. We paid 5% to the insurance company to use that money. Well, this tells me I just made 44% this year on doing a 12% private money loan. So let's think about the alternative for a second. If 8 years prior, she would have never started this policy right here, what would she have done with that $150,000 and that $50,000 a year going into this? Well, she still would have had the money. She would have just put it into somebody else's bank, and she would have felt good because she had a big balance in her savings account that she was using. But when she pulls money out of her savings account, does that money in the savings account continue to grow? Absolutely not. It's gone. And if she spends it, it's really gone from her life. So this is just an alternative. Your money has to go somewhere. So why not put it into your own banking system, make you and your family wealthy, as opposed to somebody else's bank like Wells Fargo or Chase, and make them and their families rich? It's your choice. Your money has to go somewhere. So what would you rather do? Would you rather make 12% or 44% in your money, not working any harder, not working any longer, and not taking on any more risk? And at the end of the day, the infinite banking concept and using these policies this way is literally that simple, Chris.
You know, one of the things I think we could probably do is let's go to the audience. You know, we got over 100 people on here right now, which is amazing. And let's just see, does anyone want us to illustrate anything on the board here? Because like, I'm getting antsy to start drawing something. So you've seen the numbers. We've talked about various different ways you can do this, but you know, there's somebody else's deals that we're talking about. There's somebody else's policies we're talking about. So in the chat right now, or actually specifically in the Q&A, does anyone have a particular situation they're dealing with? It whatever you want. It could be, you know, you got a question about your current investment portfolio. You got a question about something that somebody recommended to you or talked to you about. Maybe you just got a scenario like, hey, I'm looking to do this, and I was wondering what that would look like. Let's get some of you to chime in and give us some examples, because sometimes that's more fun if we actually have all of you on here help us. And just as a roll call, I want to show you this audience because, you know, obviously virtual, you guys can't see each other. Over in the chat, any of you that have equity in your house, have an old 401k, have a self-directed IRA, or have money available in your cash value whole life, put I in the chat. These are all the folks that have money that want to make more money. So put I in the chat. And I want all of you that need money to pay attention to this. All these folks that are putting I are all people that right now have lazy cash sitting around. Some's more lazy than others, but they all have money that they want to get working for them. And if I, you know, and I should probably put mine in there because I have a little bit of money that I want to lend. I just did a small loan, but right there. So all those people have money. Now, what I'd also like to do as that slows down, I'd like to know how many of you on here need money for, I don't care if it's a business, I don't care if it's a piece of real estate, like how, not money to pay your bills, but like legitimately, how many of you on here need money to do an investment in real estate or something, put need in the chat. Like the coolest thing is no matter how many events we do, no matter how many virtual trainings we do, we ask this question at every one of them and we always get this. And this is the basis of what Private Money Club was built on. Literally, people with money meet people that need money, and both of them are win-win because both people are making money and fulfilling on what they need. It's such a cool freaking thing. And we got a couple over in the Q&A that I even said need and I. But I mean, think about that. You're on a webinar with a little over 100 people, and every one of the 106 people on here either have money or need money. There is no one that is not on one side or the other, okay? So based on that, what opportunities are we not taking advantage of because we're not applying ourselves, because we're not going to Money Tank in Raleigh, because we're not getting a virtual ticket to Money Tank, because we're not participating in making this happen? Like, we got to think about that, right? So let's come over here to the question. So David Long said, cause for the death to decrease 6 to 10. David, I'm not maybe understanding exactly what you're asking.
Yeah, absolutely. Let me just pull it back up, the presentation. Oh,
okay, gotcha. It was on yours.
Yeah, so right here, I'll show you. So if you're looking at the death benefit over here, you'll see how it's higher at the beginning, and then in the 8th year, it drops. The reason for that is, like I mentioned before, when we build the premium of these policies, we do a mixture of base and paid up additions. And if we have to add some term onto the policy. Now, the only reason we would add term onto the policy is to abide by the IRS rules and regulations known as MEC or 7702 rules. And so, but when it comes to term insurance is pure cost. Now, remember, cost is only an issue in the absence of value. In this case, the added cost of the term insurance is worth its weight in gold because it allows us to get this huge dump into the policy and allow the money to start compounding for the rest of their life and give us access to this high cash value to pull the money right back out. Without the additional term on there, this would not be possible. And so we layer in some term on this thing to be able to build them these ways. But because of the way they measure the MEC rules, it's called the 7-pay premium rule. And so when we create these things and design these things, we want to get rid of the term as soon as we can. So typically we can drop that term from the policy or start reducing it sometime between years 8, 9, and 10. So if we have to add term, you'll always see it drop off. But what is term? Term just buys additional death benefit. So that's why you see the high death benefit while the term is on there. As soon as the term drops off because it's no longer needed, then the death benefit's going to drop off a little bit, and then it'll start to grow again from that point forward. Does that make sense?
Makes perfect sense. Yep. And then Vicky said, can I put money from my IRA into this account? So Vicky, I would probably not do that, because if you take money from your IRA to fund your policy, you're creating a taxable event. And if you're not 59 and a half or older, you're also facing a 10% early withdrawal penalty. So you gotta, and let me just draw this for you because this will make it a lot easier. You have to understand, with IRAs and with the policies, we have two sides. We got one side, which is qualified money. And all I want you to think of is, with qualified, this is retirement, deemed by the IRS as retirement money. So your IRAs, your 401ks, they have tax advantages, so to say. They're kind of tax traps, but we'll call them tax advantages that allow you to get pre-tax deduction, grow tax deferred. So over here, the magic number is 59 and a half. So if we take money out prior to 59 and a half, we face a 10% IRS penalty, plus we got to pay taxes, okay? So you're going to lose taxes and 10%. So most people are looking at 30 to 40% that they are going to give up by taking money from their IRA and going over here to what we would call the non-qualified side. So the non-qualified side would be things like your savings account, your checking account, and also these IBC policies that we're talking about. Okay, these would all fall on non-qualified. So you'd have to be careful moving money from there. Now, I'm not saying it hasn't been done, and in some cases it does make sense. And where it would typically make sense is if your IRA was small. Let's say it was like $7,000 to $10,000. Okay, in that case, this is probably not doing a whole lot where it's at. So a lot of times people say, well, let me just take the tax hit now, rip the Band-Aid off, move it over here, and then I'm going to add to it and have it grow. But I would also argue, okay, why not just add to it here and move this IRA to a self-directed IRA where now we can start adding to this, get this to a level that we can lend or do things. Now, I get both sides of the equation. So I'm not saying one, or the other is better. I just always throw caution to the wind about taking money from an IRA and moving it into the policy, because I know your CPA is going to say that was a stupid thing for you to do. Who told you to do that? And then all of a sudden they're going to come after me saying, well, you should have never made that recommendation. So I'm not making that recommendation, but you could run the math with your CPA. And if it made sense, then you should move it. And then let's see, questions. So Lorraine said, please explain the insurance company charging 6% interest for the loan. I get that. I borrow money out and I'm charged for my own money. All right, so Lorraine, I got a really great way to show this. Now, the numbers might not jive with yours, but let me just show you a real client's example. We build these sheets for all of our clients if they want after their policy's in force. This would be part of like our advanced mapping. So we do this on a kind of one-off basis, but I want you to look at this. A lot of numbers, but just stick.
And I can explain the basics of it too, Chris, when it comes to simple versus compounding.
Yeah, and I think that's important, but let me just show you, Lorraine, a lot of people get hung up on the fact that the insurance company charges you interest, okay? They don't charge 6% right now. It's actually more like 5%, but you're splitting hairs. So the insurance company is going to charge you interest. And I want on here you to pay attention to right here, okay? This actually, let me get my, like Stephen did it. That was kind of cool. Right here is the loan interest the insurance company charges. So that's 5%, okay? And then down here, we just aggregate it for the year. Okay, this is your 5%. So then you're saying, okay, well, why would I borrow money out if I'm charged money on my own money? That's a really good point. But the point really doesn't mathematically make sense the way you're thinking about it. You see, when you put money in right here, this particular example, the person put $440,000 into the policy. Now, listen, Lorraine, I don't want you to get hung up on the numbers. So subtract a zero, add a zero, whatever. They immediately took the loan for $348,000. Okay, they put 440 in, immediately took out, probably within the first 30 days, $348,000. So there's your loan principal. That's the amount of interest that's going to be charged on the loan. Okay, $19,893. What you're saying is, why would I ever do that? Why would I use my own money to pay interest on my own money? Well, the reason for it is, if you were to do the math, if you put 440 in and you took 348 out, what's left? So let me just do the math for you. 440,000 minus 348. I'll just split the difference. $92,000, right? So would you rather earn interest and dividends? Because we know the policies pay guaranteed interest plus dividends. So let's just say this particular example, I think this is Lafayette, so 5.2%. Would you rather earn 5.2% on 92,000, or would you rather earn 5.2% on 440? So just let that sink in for a second, because you're probably thinking, well, of course I want to earn 5.2% on the 440, but how can I earn 5.2% on the 440 when I took 348 out? That would only leave me about 92,000. Yeah, if you're thinking about a bank account, an IRA, or any other account, but see, in the whole life, the insurance company allows you to borrow from your death benefit. They'll literally give you the loan against your death benefit, use your cash value, the 300 or 440. They'll use the 440 as collateral. So they're collateralizing the loan, kind of like what we just showed with all the real estate lending. And now you've got 440,000. Now, this isn't going to be the exact number, but I'll give you the gross because you got cost on this. 440 times 5.2%. $22,880. Now, let's just play devil's advocate and assume that gross is gross. This is not exactly how it would pencil, but would you be okay getting paid $22,880 if you had to give 19,000 back? Everybody would be, right? Because your bank won't do that. Your bank wouldn't allow you to put 440 in, take 348, and still pay interest on the full amount. So Lorraine, just stay with me. So now you've taken the 340 out, and you got to pay interest on that. But you already know that you're still earning interest and dividends on the full amount, which I've already penciled it and said, mathematically, that makes sense. But you see, you don't stop there. This person takes the 348,000 in loan and they lent that money out. through Private Money Club at 16%. So they lend that money at 13% in a first secured position to a lender called ROI Properties. Somebody I lend to, Stephen lends to, a whole bunch of us lend to this big developer. So he's making 13%. So now let's just look at this. They're making $45,000, which you could make if you just took the money from your bank account, you'd make the same amount. And in here, you got to give back 19, right? So we got to give back 19, which means the available amount that we would do would be $38,777 if we paid the interest out of the gains. Okay, so that's what we'd have left. So right here, we made money how many times? Remember, you have 440 earning 5.2%, and then you're earning 13%. But we got to give back 5. So 5.2 minus 5 is 0.2%. So we're making money once there. It's called a spread. And then we're making money twice here. But you could make this just from a savings account. So mathematically, if I just, now that you understand what's going on, let's just focus on bottom line numbers, because every year I'm going to do the same thing. The worst years in these policies are the first couple of years. And I'm going to show you that. Because year one, if you did this policy and you did everything I just said, you would lose 6.08%. Why? Well, because you've got a death benefit in this particular example of over $8 million. That's why. The insurance company does not work for free. They are a profit company, and thank God for that, because I love clipping dividends. I love the dividend checks they send every year, and they wouldn't send dividends if they were a nonprofit. So profit away, insurance company. So I would lose 6%. But the next year, if I did the same thing in the same policy, I'd make 1.57. You'd actually make more than that. I'm just showing you the net. But the next year, you'd make 8.39 and then 15.34. Now, that's after paying the loan interest. So I want you to make sure you understand that. Every one of these years, I'm subtracting the stupid insurance company charging me loan interest. But yet every single year, I'm making more and more money. Do you know why, Lorraine? It's called compound interest versus simple interest. And this is where I want to go next. I want Stephen to explain simple interest versus compound interest in a very simple form. But you have to understand, it's not just about the interest charged and the interest paid. It's about what kind of interest is charged and what kind of interest is paid. Compound interest is what you want. Simple interest is what you want to pay. So with that being said, Stephen, I'm going to clear my screen here, and I'm going to have you explain compound versus simple. But hopefully that helped, Lorraine. That was a very good question, and one that a lot of people have.
Yeah, sorry, I got a little distracted. One of my forklifts sold, so.
Oh man, see, Stephen's flipping forklifts with his policy.
Checking out what my profit is.
All right, so I just explained that whole thing to Lorraine. Now, what you were saying before I did that is simple versus compound.
Yeah, so this is kind of another way to look at it. And I love your example, Chris, and it's very detailed, but more on just like a basic level, like how these policies actually operate. So we just kind of asked like a question, like just to, you're asking like, well, if I'm paying 6% for my money, like how's this working? So remember, your money, even when you're paying that 6%, or really it's 5%, and when you're paying that, remember, all that money's still in the policy growing for you. And so what does that look like in the real world? Even though in the real world, we're paying less in interest than what the dividends are growing at. But so this is a very extreme example, but nonetheless, it proves the point on how this works. So if we take a look at this, can you make money earning 4% while paying 6%? Most people would say, well, no, that's common sense. There's no way to make money paying more than what I'm earning. But let's break it down and look at it a little bit different way. So just as an example, let's say you wanted to buy a car, and you've spent the last few years saving up in your savings account at the bank, and you have $25,000 and you want to go buy a $25,000 car. Now, this will work for any amount of money. Actually, one of our business associates, Mr. Burr, Devin Burr, just did this with a $250,000 car. So the exact same thing. But just to show you this nice simple example, $25,000. So you go down to the bank and you walk into the bank and you say, hi, I'd like to withdraw $25,000 from my account. They should just say, okay, it's your money. Here it is. But banks don't do that. They're going to ask you a bunch of questions. Anything over 10 grand, they're going to grill you. Why are you using the money? What's it for? Whatever. And not only that, but the bank, I almost can guarantee you, does not have 25,000 cash to give you right then and there. You'll probably have to go to multiple banks or set an appointment to come back a week later. But nonetheless, let's just pretend $25,000. So so what's going to happen is the teller is going to say, hang on, I'll be right back. They're going to get the bank manager. The bank manager is going to come over. And by the way, that bank manager, what do they have on their little name badge? They're called a vice president, right? Do you guys know why they're all vice presidents at banks? It's because it gives the bank legal ability to purchase you guessed it, whole life insurance policy on that bank employee. By being a key employee, a vice president, and there's vice presidents, a bunch of them at every single bank that you go into. That's why, because banks are the largest purchasers of whole life insurance in the country, in the United States of America, whole life. So anyways, that's just kind of a side topic. So that manager comes over and they say, listen, I understand you want to go buy a vehicle for $25,000. Congratulations on saving your money. However, I'm going to make you an offer. What we're going to do is we're going to give you a magic savings account. And instead of paying you 0.4% in your savings account, I'm going to bump you up to a 4% annual return in this savings account. And then what we're going to do is we're going to take your savings account, use it as collateral, and I'm going to give you a loan for $25,000. So that way your money is in your savings account. You don't lose it. It's growing for you. And you can go buy that car that you've been saving up for. And you're like, hell yeah, that sounds great. Thank you so much for doing that. Like, well, what's the loan going to cost me? And they look at you and they say, well, the car loan is going to be for 6% annually. And you look at them and you're like, you know what, Mr. Banker, I'm not the smartest guy in the world, but I know enough that like basic math, I'm not going to let you give me 4%. I'm going to pay you 6%. I'm going to lose money. Like, just give me my money back. And the banker's going to say, no, let me show you this. And you guys can do the math. I've already done it for you. So let me show you how this breaks down. All right. So we have the bank over here with the savings account, the $25,000, 4%. And over here, we have the 6% car loan. Now, a typical car loan at that amount is going to be for 5 years or 60 months. However, when you get a car loan, what happens when you make that monthly payment each month? So if I do the math, that's $483 a month. Well, what happens is every time you make that monthly payment, that $25,000 balance gets reduced. So the first month is 25, the second month it's 24,618. The third month it's less and less and less. So throughout the year, the balance is diminishing. What is that 6% being charged on a car note? Well, the way that these simple interest reducing balance note, like for example, a car note work is that 6% is charged on the balance of that car loan. So that because that balance is lowering every month and every year, you're getting charged on less and less a month. So at the end of the 5 years, that $25,000 will be worth $29,000 to the bank. So about $4,000 in interest was paid. Now let's look at the $25,000 in the savings account over the same 60 months, but at only 4%. We actually grows to just be over $30,500. So what happened over here? Well, over here, that $25,000 was the first year, and then that money grew by 4%. So the second year, let's say it was $26,500 balance. Well, that $26,500 was then growing by the 4%. So you're getting up more growth on that same 4%. The second year, your money of 4% is growing at, let's say, $28,000. So by the end of the 5 years, it's grown on a higher balance each year, which has given us more and more money. So while you would think that you would lose money in this scenario by paying 6% and earning 4%, you actually would have made over $1,500 in this scenario right here. And that's just a great example of when we use these policies, even though we're paying that simple interest to the insurance company to use the money, our money's within that policy doing what? It's compounding uninterrupted at that dividend rate, even when that money's out of the policy. And that's what allows us to get this uninterrupted compounding growth and simultaneously use the money. And then what happens with compounding interest? Well, it gets stronger and stronger and stronger and stronger every year for the rest of your life. In fact, this was what Albert Einstein said. Albert Einstein called compounding interest the 8th wonder of the world. He said, those who understand it use it, those who don't pay it. And then when we have uninterrupted tax-free guaranteed compounding interest for the rest of your life, do you see where the power of that comes in? That's why when we create these policies are great for people in their 50s, their 60s, their 40s, like Chris and I. But when we create these policies for people in their 20s, for kids. I get so excited as the advisor because I know how powerful that's going to be for that young person for the rest of their lives. It's unbelievable what these things look like over time. Let me just show you a quick example. So here was a policy where this individual dumped in $50,000 up front and they did $500 a month going into the policy. So look at this thing over time. I mean, in the 10th year of this policy, that compounding return was 55%. In the 20th year of this policy, that compounding return within the policy was 191%. 25 years into it, 281%. But look, the second year was only 21. Why does that happen? Because of the uninterrupted compounding returns. And remember, this policy is going to grow like this, whether you're using that money or not. So that's why we encourage you, put the money in and then take it out and follow the process. It's the infinite banking concept. It's not just the whole life policy. The whole life policy on its own, hell yeah, that's great growth. It's tax-free. You have a death benefit. But when you couple that with being able to move your money into real estate, into business, into notes, into private loans, into private funds, the list is endless. That's where you really start generating wealth. That's how you put yourself on a much better successful path. And that's how you create not only wealth for you and your family now, but also generational wealth, where we can start talking to you about using trusts and keeping the stuff and controlling it from the grave and really creating something special for your family.
I love that, Stephen. That's perfect. And Lorraine, I know you just said you had a light bulb go off. And how many of you on here that have seen this a couple of times? How many of you have had that light bulb moment? I know I have. I've had that light bulb go off. You know, sometimes it takes a couple of times of seeing it different ways. You know, the wall of numbers, sometimes like it's just tough to kind of get through it. But eventually something happens and you just have that light bulb moment, like Vicky said and Tess. But Lorraine, I just wanted to kind of show you one more thing on the screen here, you know, because this is another thing that's always important to understand is there's really one of the confusing things about what we do is there's three interest rates we're talking about. Number one, okay, the first interest rate we're talking about is the interest the insurance company is paying you. So with dividend, so it's interest and dividend, they call it the dividend crediting rate. We're just use Lafayette's, which is 5.2. Some of the companies are higher. We can get anywhere between 5.2 and 6, depending on the carrier. And most of the insurance companies right now are charging 5% or less on the loans. So this is the second interest rate we're talking about, is the interest rate that they're charging on the loan, 5%. But they're paying you compound interest and charging you simple, which is what Stephen just went over. But even if you just do it straight from the surface, 5.2 minus 5 is still a positive 0.2. So this is gain number one, okay? Gain number one just from the surface level. But over here, if you were to take the money in that example I gave you, you lent it out at 13, you could also look at this one and you could say, this is interest rate number 3, which is the interest you're earning. So the interest that the insurance company is paying you compounding, the interest the insurance company is charging you, the interest that you're earning from lending it or taking back debts. But a lot of times we can do this one of two ways. We can either subtract the 5% the insurance company charges from what they're paying you, okay? But the way I kind of like to do it, because it's just easier for people to rationalize, is if you're making 13%, we take away the 5 the insurance company charges you, you're making 8. And then over here, you're making the full amount, which you just saw the percentages on Stevens. I showed you the percentages before. So just always remember there's 3 different interest rates we're talking about. Interest paid by the insurance company, always remember compound interest, uninterrupted. Interest charged by the insurance company, always remember simple interest. Interest rate that you earn on the money, your money working for you, that interest rate, and you can subtract the 5% from either side. Doesn't matter. That's why I wrote either way. We could kind of split it right in the middle. You pick and choose. But that's the best way to look at that. It's a great question. It's a question a lot of people ask. So I'm glad you asked that. Now, I know we're getting to the end, but I wanted to, earlier I said, why, Lorraine said, why isn't everybody doing that? Yeah, the light bulb went off. Lorraine, we say that every time. I can't understand why everybody isn't doing this. When they see the numbers, I met with a guy locally here in Buffalo. I don't really do much business in Buffalo just because a lot of the people, it's very difficult to get their mindset in the right place. But I met with a friend of mine, very wealthy man, and I showed him this. And I was explaining all this stuff that you're hearing me and Stephen explain. And he said the same thing to me. He said, why doesn't everybody do this? And I said, I don't know. why doesn't everybody do this? He said, I can't see one reason people wouldn't. And I said, the only reason people would not do this, there's two reasons really. Number one, they don't qualify medically. They can't get the coverage. But number two, believe it or not, there are people out there that are not willing to give up returns for 2 or 3 years to get paid returns for the rest of their life. Like there literally are people that will not just get over the hurdle that in the first year they're going to lose money. They're like, oh no. But yet that exact same person is the person that will stay in the stock market and lose money when the market goes down and be like, oh, that sucks, and bitch and moan and complain about it. So you just got to understand it's a mindset thing. You will not make much the first couple of years because you've got a cost of insurance. And remember, in year number one, I mean, your money hasn't really been working for you any more than 12 months. So you've only got a little bit of compounding that's happened. Matter of fact, the dividend hasn't even happened till the end of the first year. So the first year is always the worst year. Call me just a logical thinker, and Lorraine, kind of like you said, and so many other people that are saying this, who cares about the first year? Like, I'm not playing the short game, I'm playing the long game, because the second year I make money. After all costs of insurance, after cost of paying the insurance company their interest, I make money. The third year I make money, fourth year, fifth year. And and then if we look at years 6 through 14, it starts to become unrealistic, almost unbelievable, almost that's too good to be true. 30%, 44, 66, net, 90%, 118, 149, 184. Listen, these returns are not going up because the person's making more on the loan that they made. They're making 13%, always the same. The amount that they're making on the loan that they lent out is 13%. That's all I show. So that return's static. The amount they're paying is static. So what's the difference? So how do numbers continuously go up? Albert Einstein could tell you the answer. Uninterrupted compound interest is the only reason this happens. And the only vehicle on earth that can do what you're looking at on the screen is a specially designed whole life policy. Really, I should just say is a whole life policy. So why doesn't everybody do this? I don't know. But there's an awful lot of people that try to punch holes in this and try to find reasons to not do this. But it always comes back to the single solitary thing that Will Rogers said. The biggest problem in America is not what people don't know. The biggest problem in America is what people think they know that just ain't so. It's the only answer I can give when people say, oh, I don't know if I'm going to do this. I don't know. Maybe I'll do this. I got to think about it. It's not what you don't know. It's what you think you know that just ain't so that's holding you back. One more thing I want to hit with the policies, and it's very important. Everything we just went over, we talked about taking a policy out in your personal name and doing all this stuff, the private lending, the Initio fund, all that stuff. We talked about doing that all from your personal name. But some of you have businesses, and some of you that have businesses, you have a bunch of cash sitting idle in your business. Maybe it's for a future purchase. Maybe it's just an emergency reserve fund. Maybe it's your war chest, like my war chest. And you're probably looking at that saying, boy, I wish that would make a little bit more than what the bank's paying. Well, it can't. Everything you just saw us show with these policies, they can be corporate owned. Matter of fact, it's got an acronym. You can look it up online. COLI, company owned life insurance. It's kind of a thing. Yeah, companies like Apple and Samsung, yeah, they use this. You know what they do? They take their money that they use to buy their raw goods, they put it into a policy. We used to talk about this all the time. They put it into a policy. So the company takes the money from their bank account, they change one thing and they put it into one of these specially designed policies, okay? And then what the company does is they take loans from that policy and they buy or they use it for business, whatever, business operations, okay? And I would not like rent and that, but they use it to buy supplies, okay? A lot of companies will use it to buy equipment. That's what we do here. I buy equipment with it. A lot of companies will use this to invest. Like my company, right now I have $250,000 of our company money loaned to ROI Property Group. Why? Because I make 13% on the money, and the money's in the company, but I don't need the money right now. The money's for future acquisitions. So that money doesn't need to be sitting in a bank account. I'm sending it out to work, but it makes all the more sense to put it in the policy first. Because you know what? Here's another thing. If you're thinking, if you got money in a business, in order to take that money out of the business, it would trigger a tax. You have to pay tax on it, right? Because it would come out as income, or it would come out as a distribution, which would affect the amount you can take out of your company. So a lot of times business owners don't want to take money out of their company because they don't want to pay the taxes. Totally get it. So why take the money out of the company? Keep the money in the company. Just have the owner of the policy be the company. I mean, you own and control the company, right? So have the owner be the company, which gives you the full control to do whatever you want with it anyway. But here's the other cool thing. Let's just say something should happen to you. You die. Well, that company is going to need to hire somebody. It's going to need a new CEO. And if your children and your spouse don't want to take over the company, well, the company is going to need some money to hire that person. So in an example of COLI, there's also a death benefit, which we never talk about. But in a company scenario, boy, does that death benefit become really, really powerful. Because if I die, the company gets the death benefit. The company then can pay out, my family. So my family gets paid for whatever they want because they own the company. Because if I die, they become the owners of the company, but the policy buys them out because they don't want to do anything to do with the company. It's too much work. They don't know anything about it. Or how about in the scenario of a partnership? Lots of companies have partners. So let me just kind of show one more thing and then we'll wrap on this. Thanks for sticking a little bit over. Partner A and partner B. Each partner in a business owns a percentage. So let's use 50-50. Now, any of you that own a business that have a partner, sometimes it's not all rainbows and roses, okay? So a lot of times in a scenario of a partnership, if you like your partner or don't like them, it doesn't matter. If partner B dies, okay, I got to kill him off. So partner B dies. Does partner A want to be partners with partner B's spouse? Now, maybe, but probably not. Does partner A want to be partners with partner B's attorney? Definitely not. So do you see, when we add this COLI policy, and in this case, we would add two. We'd add one on each partner, okay? It's called a buy-sell. And there's different ways to do this, so I'm going to keep it super simple. Buy, sell. The policy gives the owners the ability to buy or sell. Okay, they can buy new companies with the cash value, but they can also sell. So all it basically does is if partner B dies, partner B's death benefit pays back to the company. We'll just put the company here, okay? Pays to the company to buy out partner B's share to the family. So partner B's spouse just gets a big check. And it was paid for not by company assets, but it was paid for by this stupid whole life policy. And same thing, if partner A died, partner B would get, the company would get the money and partner B would be able to buy out partner A's family. So there is no issues anymore. And it's using the insurance company to buy out your partner. It's taking no money out of the company because all the money that went into the policy, remember, what's that doing? Buying equipment, buying supplies, investing. It's all the same. But you didn't have to pay tax on the money because it's all within the company. On the balance sheet, when you go to take a loan from a traditional bank, God forbid that you ever have to do that. But if you did, on the balance sheet, it just says cash value life insurance, and the bank knows what that is. It's the same ranking as a bank checking account. Actually, probably better because there's a death benefit and it's guaranteed. So that's COLI. So we don't talk about this a lot, but we need to be talking about it more because there's so many different ways you can use this. Key person, split dollar, buy, sell. There's all sorts of strategies in the business world where you can do this. So if any of you are business owners, have a bunch of idle cash, don't know what to do with it to get it to make more money, this might be your solution. Stephen, anything you have to say on that?
I love it, man. It's great stuff.
Yeah,
Really
Julie just said, this is how my FIL structured the buyout on perfect. And I didn't get to that, but I love that because remember I was mentioning buy, sell. You could use the policy to buy the other partner out. I structured a plan for a guy locally here. He's got a really good company. And literally the policy that we built is structured so that his employees, which are also his family members, can buy him out. They're just funding the policy, using the policy's cash value to do business. And then it's structured so at a certain point in time, almost as a, what do they call that? There's a name for a sunset clause, or there's a sunset for the one partner, and the other partners, his family members, his employees, they're going to buy him out using the proceeds, just like Julie just said. Folks, this stuff is used over and over. We're not the inventors of this. This has been being done for generations, for decades, for centuries. The question is why are you not doing it? That's it. That's all we got. As we would say, that's it, that's all in the snowboard world. It was a Red Bull video, but I hope you guys enjoyed today's training. I just want to recap just a couple things that we went over. Number one, we've got an event coming up August 4th and 5th out in Raleigh, North Carolina. We'll put that link up here right now. You can get your tickets. Now, I know we're kind of halfway through July, so we're coming up on it quick. So I wanted to give you a half off offer. If anybody wants to go to Raleigh, we'll give you the general admission tickets half off. Okay, so there's a discount code you put in. But for some of you, if you can't go live, but you still want to attend, or you're not going to be around that weekend and you just want the recordings from the live event, we've got a whole virtual program that we're putting on. And the virtual program actually will have additional speakers that will not be in the live event. I'm not saying that's better or worse. It's just we have more time in the virtual because when we're on lunch, we have speakers going on the virtual. It'll all be edited and sent to you after the event. And those tickets are normally $297, but if you want them, I'll give them to you for $97 today, just for sticking around to the end, because there's 84 of you. So there's your link, there's your discounts. What I'd ask is that all of you just copy and paste that, put it in your notepad, write it down on a piece of paper. That'll be good for through the rest of today for those discounts. And the other thing too is we've got a training tonight if any of you want to join us, 6 p.m. So you can just go on any of my social media platforms and register for it. The ads are everywhere for tonight's training. And we're going to be going deeper into private money lending and private money borrowing. And that'll be tonight's little program. So we hope to see all of you, and any of you that want to get into Inicio one very last time, you can just get a hold of Steven. He can send you the brochure. There's his email right there, snaggy@privatemoneyclub.com. And you can get all the information on the fund before it closes July 31st. I think there's 31 days this month. Yeah. But with that being said, thanks for joining us for another wealth webinar. It was awesome having you here. Thanks for your time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.